So this is the practice exam for the first exam in Accounting 2301. And this first one that I'm going through doesn't have any heading on it. So it starts with number 60 here. The primary responsibility for information reported by a company rests with the company's management. They are responsible. A lot of people think it's the accountants. It's not. It is the company's management. Number 67, in addition to the 4 required financial statements, which of the following is a required disclosure in the annual report by a publicly traded company? B is notes and footnotes, and C is management's discussion and analysis. So D is the correct answer there. Number 85. On January 1st, 2006, Story Company had 60,000 of retained earnings. During 2006, they earned net income of 100,000 and declared and paid dividends of 15,000. In addition, the company received cash of 25,000 as an additional investment by owners. Therefore, the ending balance and retained earnings. So this is just our inventory formula, the beginning, which is 60, plus our additions, which in this case is net income, which is 100,000, minus any withdrawals, which would be the dividends of 15,000. And so that would be 145. The cash received for the additional investment would go into paid in capital, not into retained earnings. So D is the correct answer there. Number 67, on January 1st, 2007, the Legend of Global Corporation correctly showed supplies inventory of $1,000. During 2007, supplies purchased amounted to 5,000. Account of inventory on hand December 31st showed 12,000. The 2007 income statement should report supplies amounting to. So this is the same in inventory formula. So our beginning. So this is the exact same we did up here, except we know the ending amount, so we have to get the withdrawals. So we reverse that a little bit. So our beginning inventory is 1,000. Our purchases, which is our additions, is going to be 5,000. That gives us a total of 6,000 available. Then we know the inventory, the on hand is 1,200. So 4,800 is our amount used. The expense will be 4,800 or C. Number 93, the primary purpose of the statement of cash flows is to report all inflows and outflows of cash during the period. And 76, the primary difference between revenues and gains. Gains are increases in net activities from peripheral activities, while revenues are increases from ongoing activities. That is true. They generally accepted does. Let's see. Go up here. Revenues can cause increases in net assets as a result of peripheral. No, that's wrong. And both revenues and gains cause decrease. No, that's wrong. So the correct answer is A on number 76. Number 84, if total revenues exceed total expenses, the company has a net profit. All right. Number 94, the cash basis of accounting is not appropriate for use by publicly trading corporations because, well, A is not right. Investors are concerned about cash flows. No, B is not right. The income reported would be distorted if a large customer paid for goods in advance or we postpone paying the next accounting period. That is true. So C is the correct answer there. Number 66, Michael Corporation received $200,000 cash invested by its owners. The effect on the fundamental accounting model would be that assets, where assets equals liabilities plus owner's equity, assets would go up and owner's equity would go up. So stockholders' equity and assets are both increased by $200,000. D, the purchase of equipment with a note payable would increase assets, but that's not one of our choices. And it would also increase a liability. We now owe more, right? Number 95, an example of an investing transaction. So this is a cash flow statement. We really haven't gotten there yet. So let's just ignore that for now. Number 45, the financial statement that reports the financial position of a business is the balance sheet is the correct answer. I haven't even looked at the other one. Statement of cash flow is not. So yeah, that was the correct answer there. B, the balance sheet. Number 71, accounts receivable represents A, amounts which are owed to customers by resulting from credit sales. 78, on the statement of cash flows, we're not there yet. We can skip that. Number 42, 4 transactions are given below that were completed during 2006 by Story Company. The annual accounting period ends December 31. Each transaction will require a adjusting entry on December 31. Provide the adjusting entry. So A, on January 1st, Story Company purchased office equipment that cost $20,000. The estimated life of the office equipment was 5 years with $2,000 residual inventory, residual value. So we have $20,000 is the purchase price, and $2,000 is the residual value. That gives us $18,000, what we call depreciable value. We divide that by 5, and that's going to be $3,600. And so our adjusting entry, I didn't leave myself enough room here, but the adjusting entry would be depreciation expense for $3,600 and accumulated depreciation, and it would be equipment for $3,600. Okay. Then B, on June 1st, 2006, the Story Company paid $2,600 for 1 year's rent beginning on that day. The rent payment was recorded as follows. So we have that. So if we divide that by 12, because each month, right, would be 1,050, I think. Yeah, 1,050. Okay, so now we've got June 1st to December 31st. So June, July, August, September, October, November, December. So 7 months. Would be 7,350. So our adjusting entry would be rent expense 7,350 and prepaid rent 7,350. So remember, anything that is a prepaid is going to be an asset. Anything that is unearned is going to be a liability. Okay, C on this one. So we're continuing with the adjusting entries. Story Company purchased office supplies during the year that had cost $700. Placed the supplies in the storeroom as needed. The purchase was recorded as follows. that. At the end of 2006, account showed unused office supplies of $200. There was no beginning inventory of supplies on hand. Okay, so we do our T account, supplies. Supplies is an asset, so when we purchased it, there's 700. Now we know at the end of the period there's 200, and so the difference there is 500. Our adjusting entry is going to be supplies expense and supplies. So we're decreasing supplies by 500 on that one. And then on D, Story Company owed employees $2,000 for wages earned during December. These wages have not been paid or recorded. So the December 31st entry would be wage expense 2,000 and wages payable 2,000. Okay, number 106, 160, Part A, perform transactions analysis for Glake Company regarding the following transactions for March. Indicate the account affected in the transaction, as well as increase or decrease to the components of the financial accounting equation in the amount. All right, so turn off my phone here a second. All right, so customers paid $2,000 on their accounts in March. So cash is going to be affected, and these are the customers, so it's going to be plus 2,000. And we're also going to have accounts receivable minus 2,000. Okay. B, services were completed for customers. A total of 1,500 was billed, but none was received in March. So the asset is going to be accounts receivable, and that will be a plus 1,500. And then we're going to have stockholders' equity is going to be service revenue plus $1,500. C, we paid $3,000 for rent for April, May, and June. Now, remember, these transactions are all in March. So it's going to be prepaid rent will be our asset. And that will be plus 3,000. And our other will be cash. And that will be minus 3,000. D, we paid March utilities bill for $150. So the asset will be cash minus 150, and the stockholders' equity will be utilities expense plus 150 there. Okay, E, new investors purchased Blake Company stock in March for $3,000. So our asset will be cash plus, or 3,000, excuse me. And then we'll have stockholders' equity will be common stock. Paid in capital would work as well. 3,000 here. And then finally, we paid last month's fuel bill for $1,000. It was recorded as an expense last month. So the asset would be cash less $100. And we no longer have the liability, which would be accounts payable for, and that would be minus 100. Okay. Part B, determine whether the transactions A through F above affected cash flows. Okay, we have not done this yet. You're not responsible for that. Don't worry about it. Number 106, for each account listed below, enter a check mark in the space provided to the right to indicate it where the typical balance is a debit or a credit. Inventory is an asset. All assets, normal balance, except for contra asset, is a debit. Notes payable is a liability. Liabilities, normal balance, is a credit. Retained earnings is an owner's equity, and credit is the normal balance. Equipment is an asset, and debit is the normal balance. Prepaid insurance, all prepaids are an asset, so the debit is the normal balance. Accounts receivable is an asset, debit is the normal balance. Land is an asset, debit is the normal balance. Contributed capital is an owner's equity, the normal balance is a credit. Accounts payable is a liability, the normal balance is a credit. And unearned revenue is a liability. Normal balance is a credit. All unearneds are liabilities. All prepaids are assets. Number 108. The accounts with identification letters for Playworld are listed below. You are to indicate the appropriate journal entry for each transaction by giving the letter and amount. Some entries need 3 letters. The first transaction is given below. So this is our list of here. Okay, we purchased equipment for $5,000. So we're going to have D, equipment, for $5,000. We paid $10,000 cash. That would be A for $50,000. Excuse me, getting in a hurry. So that would be minus $10,000, and then we signed a $40,000 note payable. Notes payable is G, and that would be $40,000. Okay, C, we collected $15,000 in accounts receivable. So A is cash for $15,000, and accounts receivable is B for minus $15,000. D, we paid $12,000 of accounts payable. So A is going to be cash for minus $12,000. And accounts payable is F for minus $12,000. E, we issued capital stock in exchange for $60,000 cash. So we get A of $60,000, and we get contributed capital of H for $60,000. F, we purchased $5,000 of office supply. And it tells us here it's an asset on credit. We don't have office supplies. It is an asset. Oh, yes, we do have office supplies. C, office supplies. So that's $5,000. And we bought it on credit. So that's accounts payable, F, for $5,000. And then finally, we paid for the office supplies in F. And so that would be A, cash, minus $5,000, and F again, the accounts payable, for minus $5,000. All right, so that's the first one. that I sent you. Okay, the next one is summer of 2006. I think I told you at the beginning of the year it was a busy semester. It's been a while since I taught this class. The Securities and Exchange Commission reports that required to be filed in any special event that is material in amount is the 8K. The 10K is the annual report, which is required, and the 10Q is the quarterly report that is filed, and the prospectus is when you're going to issue stock or bonds. Okay, number 2. On April 1st of 2007, a premium on insurance policy on equipment was paid amounting to $3,000. At the end of 2007, the statement for 2007 would report. Okay, so we need 3,000 divided by 12. So that would be $250 a month. And we would have April, May, June, July, August, September, October, November, December. So 9 months. So that would be $2,250. So our insurance expense would be $2,250, and that makes no sense. None of the above is correct. The insurance expense, $2,250, and prepaid insurance, $2,250. So none of the above is correct there. 3. During 2007, Sigma Company earned service revenues amounting to $700,000, of which $630,000 was collected in cash. The balance will be collected in 2008. The 2007 income statement should report the amount for service revenues. It would be $700,000. This is accrual accounting. If we were on cash accounting, it would only be the $630,000, but we're on accrual accounting, so it's $700,000. Number 4, on a balance sheet, assets are listed in the order of ease to conversion of cash, what we also call liquidity. Number 7, what would be the effect of December's income statement of a utility bill received December 27, but which will not be repaid until January 10th? Okay, on the income statement. So it would be an expense, so that would lower the net income. So no expense is not correct. Would cause an increase in income. No. Recording the expense in December will increase expenses. That is correct. But the income will be decreased in December when we record the expense, not when we pay it. So D is wrong. So that. Okay. That one was an easy page. Number 8, we would report changes in stockholders' equity. Okay, that's a cash flow statement. We're not there yet. You're not responsible for it. Number 9, the following amounts are reported in the ledger of Mariah Company. Assets, $80,000. Liabilities, $36,000. And retained earnings of $12,000. What is the balance in contributed capital? Okay, so we have assets of $80,000 equals liabilities of $36,000 plus owner's equity of $12,000. So that's $48,000. It's $80,000. I put the comma in the wrong spot. $80,000 minus $48,000 would be $32,000. So we need $32,000 in order to make this balance. 32 and 12 is 44, plus 36 is 80. And so we have $32,000 credit. Number 10, assume Idaho company recorded the following adjusting entry at the end of the year: insurance expense 2,000, prepaid insurance. If the beginning balance of prepaid insurance was 500 and 2,500 was paid for insurance premium during the year, the ending balance in prepaid insurance account would be. So here you do your T account, and this is for prepaid insurance. We are told the beginning balance was 500. Remember, prepaids are assets. We also paid 2,500, and at the end, we did insurance expense and took out 2,000. So we would have 1,000, and it would be the debit there. Revenue is always recognized when it is earned and not when it is paid. Okay, which of the following would not be considered a current asset? Inventories are current. Okay, remember the definition of a current asset. Yeah, this was like the first day of class. Definition of a current asset is something that will be converted to cash within a 1-year period. Okay, so we expect inventories to be, we expect prepaid expenses to be. We do not expect land to be. Accounts receivable we expect to be. So land is the only answer there. Okay, number 13, the principal that holds all expenses earned in earning revenue should be identified with the revenue recognized and reported in the same period is called the matching principle. Now, I did not go over this in class, but it should be in your reading. Right, the matching principle. Number 14, in what order are current assets usually reported on a balance sheet? It's from most liquid to least liquid. Right, the one we had very similar to this earlier was, and the answer was converted to cash. That's what liquid means, from most liquid to least liquid. And the basic financial statements prepared for following users include all of the following except, so the balance sheet is one, the income statement is one. We don't do sales statement. We do a statement of cash flows. And of course, the fourth one is statement of changes in owner's equity. So C is the correct answer there. There is no sales statement. That's actually in the footnotes of the financial statements. Okay. 10 independent transactions for the interstate corporation listed below. So that we had one very similar to this earlier. We purchased office equipment for cash. So we're going to debit C, office equipment, and credit A, cash. We issued shares of interstate stock in exchange for cash. We're going to debit cash, and we're going to credit contributed capital, H. We recorded depreciation expense on the factory equipment. And so we are going to debit the expense, operating expenses, J, and we are going to credit, it would be the accumulated depreciation, which is D on that. Remember, accumulated depreciation is a contra asset, contra being opposite. And so its normal balance is a credit, while all the other assets are a debit. We borrowed cash from a bank on a note payable, so we're going to debit cash. We're increasing it, and the notes payable will be the credit for F. We provided services for credit, so that's B. Accounts receivable will go up, and service revenue, I, will go up. 6. We paid operating expenses with cash. Okay, so the cash is going to be the credit, and we're going to say operating expenses here. It is possible that it would be an accounts payable if we had recognized them earlier. We provided services for cash, so the cash would go up, and then the service revenue would go up. On 8, we paid interest on the notes payable, so the cash is going to go down, and interest expense is K. That would be the debit. We incurred operating expenses, but cash has not been paid. So J is going to be the debit, and here we have E, the accounts payable. And finally, 10, we declared and paid cash dividends to stockholders. So cash is going to go down, and retained earnings, L, is going to go down. And retained earnings is an owner's equity account, and so we decrease owner's equity with a debit. Okay, number 17. Zone Company rendered services to customers amounting to $20,000 during 2006. The related cash was collected as follows: 2006, 16,000, 4,000, and 2007. During 2006, 8,000 was incurred for wage expense, and the related cash payments were made as follows: 6,000 in 2007, and 2,000 in 6,000 2006, and in 2007, 2,000. Based only on these data, provide the following. Okay, the revenue is going to be 20,000, and it will be 0 in 2006, and then the expenses are going to be 8,000 and 0 in 2007, right? The revenues and expenses are not related to when the cash is collected or paid. That's accrual income. It's when the service is when the service is performed or the expense is incurred. Okay. All right. In each of the following, complete the chart below by indicating where the account is an asset, a liability, stockholders' equity, and where the account usually has a debit or a credit. Retained earnings is a stockholder's equity, and its normal balance is a credit. Inventory is an asset, and its normal balance is a debit. Contributed capital is a stockholder's equity, and its normal balance is a credit. Accounts payable is a liability, and its normal balance is a credit. Accounts receivable is an asset, its normal balance is a debit. Property and equipment is an asset, its normal balance is a debit. Wages payable is a liability, its normal balance is a credit. And prepaid expenses, all prepaids are assets, and its normal balance is a debit. Okay. And our last one on this one, on January 1st of 2006, Dr. Beth Hill started a new professional corporation, Beth Hill PC, to practice medicine with an initial investment of $100,000. On June 30th, the account records showed the following amounts. Okay, so this is basically a trial balance, and they're asking us for a balance sheet. We're not there yet, so I'm not going to hold you responsible for that one. All right, so that's the first two. I'm going to give my voice a little bit of a break for a few minutes, and then I will make the rest of the other two.